Good morning and welcome. Today is a class on how to use the AIO-29 layout, and we'll briefly discuss the philosophy in terms of why did we have to invent this layout. Back on January 2011, Kurt and I had our greatest letdown because for the past year in 2010, we've been concentrating on doing our best to follow our mentor from Toronto, who taught us how to use the Bollinger Band MACD in order to trade the market. The problem with the Bollinger Band MACD was that it was very discretionary. It was not mechanical enough for us to be able to consistently take a position and have it be profitable. So on 2011 of January, Kurt and I embarked on a development cycle. And essentially, we wanted to be able to, number one, develop a set of technical indicators that is easy to use, that is easy to teach, and most of all, as mechanical as possible so that there is no discretionary decision making that needs to happen, and be safely profitable. So the outcome of that development is the layout that you see today. Up here in region 1, we've got the 60 EMA, but you could be using the 40 EMA, and a line that is the average of the high-low price of the price bar. And currently, this is set to 300 ticks before the next bar gets drawn. So 300 trades need to be made before another bar gets drawn, so forth and so on. And you can see that here on the countdown timer that our current bar still has half to go before another bar gets drawn. Also with the yellow line, which is the average of the high-low price of the bar, we have the candlestick in hollow form. And you also see these dashed lines around the 60 EMA. The 60 EMA, the orange line here, is actually the zero for the price action. I consider that to be a zero line, where the price action will bounce off the zero or go above the zero to go complete a cycle and go back down again, like we saw here. The price action went above the zero, bounced off the zero to complete that cycle, went up again, and then finally did a zero cross down in order to start its down cycle. And you would notice that the cycles always create an ultimate peak or an ultimate valley before it goes back to completing its cycle, either bouncing off the zero or doing a zero cross. The other line that you see in parallel to the zero line are these light green lines in region 1. Those are defined as the mids, and they play an important part because if your price action is coming from outside the mids, then you know that trend change is going to be strong, and you can get in early enough to ride that trend up. As well as if you are in a sustained trend, your price action will stay outside the mids as the sustained trend continues. So those are the meaning of these dashed orange lines around the zero, which I consider to be the zero for the price action. Down in region 2, we have our most important indicator, because as I go through this instruction to show you how to take a position that's worthwhile, you will mostly focus in region 2. You're not going to really pay attention too much in terms of what the price action is doing, except to set buy traps or set sell traps for when the price action is actually just going sideways. Now let's describe why region 2 is so important and what is it composed of. As you would see, region 2 also has this orange line at the zero. That is the MACD zero. And that is very important because that orange line pretty much designates whether if whether which direction our market is dancing actually. If you find the MACD lines above the zero, we're in an uptrend. If you find it below the zero, we're in a downtrend. And you would notice that what are these MACD lines? We're using two MACD lines. The fastest of the MACD line is this blue line, which is the MACD difference. The slowest of the MACD line is this white line. Now, why are the MACDs so very important? What you will notice as you do your training is that once the blue MACD crosses through the zero, whether zero cross up or zero cross down, something significant may be happening for you to be able to take a position. So the blue MACD is very important to know when opportunities may be present. When opportunities may be present is shown by the blue MACD zero cross. Now, why is the white MACD so very important? The white MACD gives us the immediate cycle dance of the market. What is the market price action doing in the immediate sense? We get a feeling of that from the white MACD. Because when the white MACD makes its inflection from an ultimate, what do I mean by ultimate? Here, we're coming from the ultimate valley. The reason I call it ultimate is because it's the lowest valley that was created by the white MACD. So when we come from an ultimate, whether an ultimate valley or peak, the market will begin its reverse cycle. So if you were coming from a downtrend, you will reverse and turn into an uptrend. And again, why is the white MACD so important? Because if you find the white MACD has created the ultimate valley, and as you would notice, it's below this light green line, which signifies the mids, you are in the oversold area. And when the price action gets to the oversold area, it will want to go back to the zero. The zero of the MACD is defined as the value area where the market tends to stay 70% of the time. So what you want to do is essentially watch for these oversold when the ultimate valley gets created, and watch for the overbought of the white MACD when the ultimate peak is created. Because once you see those ultimate valleys and ultimate peaks, the greatest opportunity for you to make profit is going to be happening. And in this case, once the ultimate valley had been created here at 802 in gold, we went up. And the best time to go take this uptrend, as you would notice, is when these green dotted lines finally broke up through the zero. Yeah, go ahead and take a position for a long. Now, let me describe to you what are these green dotted lines. But first, let's review what's in region 2. So in region 2, we have the MACDs. The fast MACD is the blue. The white MACD, being the slowest, is the white. The blue MACD zero cross tells us a possible opportunity may be happening. The white MACD is very important because it tells us the immediate cycle dance of the price action of the market. What we're watching for on the white MACD is, have we created our ultimate valley or our ultimate peak? Because we know that if we've created our ultimate valley, we'll be going back towards the zero. If we've created our ultimate peak, we will be going back towards the zero. So the best places that we could possibly take for us to be profitable is when we come off these ultimate peaks and ultimate valleys. And as you can see here, the zero cross of the blue tells us that this is a great place to have taken that long because we're coming off the ultimate valley. And here, blue zero cross down at around 824 is the best place for us to go take that short because we're coming off of the ultimate peak. Now, we can't rely just on the blue MACD and the white MACD. That's why as supporting indicators, we have recruited the use of the volume zone oscillator. And that is this light dotted green line. This light dotted green line is the volume oscillator. And the reason why it's called an oscillator is because it oscillates about the zero. If it goes above the zero, it's going to bounce off the zero or go down through the zero to complete its cycle. And you would notice too that, hey, aren't the blue and the white lines of the MACD also oscillators? Yes, they are. That's why early on in our development, we found and acknowledged that the market always does its cycle dance. If the market MACDs, in this case, have gone below the zero, it's always going to go towards the zero and above it in order to complete its cycle. So essentially, what we talk about also mainly is where in the cycle are you? Are you starting your down cycle or have you started your up cycle? So in this case, with the blue MACD here at 8:01, 35 seconds, our up cycle has begun from the ultimate valley being created in this oversold region. So what we do is we wait for the volume zone oscillator to cross above the zero to be able to take this with confidence that this is going to work for us. But the volume zone oscillator is not the only helper that we have. We've also recruited the AIO-29 oscillator. And the AIO-29 oscillator is this dotted green line. When the AIO-29 oscillator also crosses above the zero with the volume zone oscillator, you have absolute confidence that you can take that on the correct side of the market so that it doesn't go against you. And when that AIO-29 oscillator gets outside the danger zone and outside the mids, so much more have you got confidence that it is going to fulfill this upcycle. And we would stay in here. Technically, you could stay in here until the AIO-29 oscillator goes back down through the zero. But why in the world would you eat this retrace? So therefore, you want to get out sooner. Now, I would like to describe to you, and you need to look into yourself, what type of trader are you? Are you a trader who can stay in for long periods of time and be able to eat the retraces? Like for this downtrend, can you stay in here and be able to eat that retrace up right here? Or are you what we call a sprinter? For I am myself am a sprinter. I get in and then I get out very quickly so that I don't have to eat the retraces because I can't stand eating the retraces. As well as you will find out that if the market truly is very jumpy or very sideways or with deep retraces, you don't want to sit in there for a long time and have the market go against you and psychologically hurt you as well as financially hurt you. So I am a sprinter. And my instruction is only for those who are sprinters. I am not going to coach you in how to be a marathoner because we are only in here in this position for a very short time. So here we know that at 8:04, 8:02, and 8:04, 20 seconds, that would be the best time to go in for that long. And we would stay in this long, until your first opportunity for exit occurs when the blue MACD crosses the white MACD. As a sprinter, I would have taken that exit. But you can stay in here because you notice that the Arun oscillator is still above the mids and hasn't crossed through the white MACD. So your second opportunity for exit is the Arun oscillator crossing through the white MACD. And that would be your exit. So in order to be a mechanical sprinter, which is our goal because we don't want to make any discretionary decisions on whether we want to go take a position or whether we should stay in and not exit, when we see number one, signal one, blue MACD cross up through the zero. Signal two, have we created our ultimate, whether ultimate value or peak? Signal three, have the green dots crossed, zero crossed in our favor? If you've got all those three signals, and as you've noticed, I never mentioned anything about what the price action is doing, because the important information for you to make a decision, to be able to take a position, is whether you've met the three signals. Signal one, do you have a blue zero cross? Signal two, are you coming off of the ultimate, whether peak or valley? Signal three, are the green dots in your favor having crossed up through the zero in this case? Yes, mechanically go in and take a position. And once you're in a position, you'll be watching how these lines interact with each other. Your first absolute exit, if you were to take it, is the blue crossing the white. If the Arun is still haven't crossed the white MACD, then your second absolute exit has got to be the Arun crossing the white MACD. And you don't violate these two exits. You take them, either the early exit or this later absolute exit. Because if you violate it, you're going to pay for it, because that may be the end of that upward trend, and the trend would have started its down cycle. Now let's take an example of a downtrend so that you have a feel for how that looks like. So let's bring this to the edge, and this is what you may see as the market is moving and developing. So you ask yourself, signal one, yes, the blue MACD crossed down through the zero. Signal two, yes, we may have the ultimate peak. I say may is because you're not absolutely sure that that is the ultimate peak, because you know that this could have gone up again, like we see here at 5:05:21 seconds. That white MACD just bounced off the zero. So therefore, what was created here at 4:34 was not necessarily the ultimate peak. But you would notice that we even if you took the 4:34 for a short, you would have still profited, provided that you got out as soon as the blue MACD V'd back up again. Now let's continue this downtrend here. So you ask yourself, do I have signal one? Yes, blue MACD zero cross down. Do I have signal two? Yes, we may have a possible ultimate peak. Do I have signal three? Yes, all of the green dots are below the zero in my favor. Yes, I go take that for a short. And I would stay in this short, stay in this short, stay in this short until right here. At 6:37, the blue is about to cross the white, and that's my first absolute exit. But you would notice that the Arun oscillator is still way down here outside the lower mids. And when you find lines outside the lower mids and they tend to go sideways and not return back into the mids, that's a sustained trend. So we may have the beginnings of a sustained downtrend here. But we are sprinters. And as sprinters, I have an obligation to take this first absolute exit and just get out and get my minimum 110 ticks, which defines my production day. But as you can see, yes, we still continued down. But look at the price action. Was that really worth staying in? Because the price action is essentially sideways. And now that we have the Arun cross up through the white MACD, that's the other signal for us to get out. And if you're a marathoner, and forgive me for digressing to be a marathon runner, as long as this white MACD remains outside the mids, we are in a continued trend. And in this case, a continued downtrend. And that's what marathoners would do. They would just stay on here and eat these deep retraces. But we're not marathoners. We're sprinters. What would have happened is we would already be out here at 6:41:25 seconds and not be involved in any more of this downward trend because of the stair stepping that's happening here. It would just cause us grief as a sprinter. However, as your skills develop, remember that these are opportunities. Because look at, you go through your signal, 3 signals. Signal 1, have we got a zero cross down here, the blue MACD at 722? Yes, we do. Signal 2, did we create our ultimate peak or valley? Well, we have to eat signal 2 because asking signal 2 does not make sense in this sense because we know that the white MACD is outside the mids. It's a sustained trend down. So signal 2 is automatically answered as yes, signal 2 is in our favor. Signal 3, are the green dots in our favor? Yes, they are. So we would have taken this short bounce off the zero. But we, as sprinters, would have been out again as the volume oscillator, which is the light green dots, cross down through the Arun. I mean, cross back up through the Arun, even though the Arun oscillator is still headed down. That's our exit, our absolute first exit. We got to take that exit as sprinters. And if you'd notice, that's only 2 bars before we have to exit. So as sprinters, why would I want to put up with that headache? No. Once we have our first absolute exit as sprinters, we should just plain stay out and wait for that turn of the trend. And we know when this trend will happen, or this turn will happen, because once again, we wait for the ultimate, in this case, the ultimate valley. We ask, yes, we do have signal 1, blue crossing up through the zero. Signal 2, yes, we have the ultimate valley. Signal 3, yes, we finally have the green MACDs going with us. I mean, the green dots going with us. The green volume, this light green volume oscillator, and this heavier dotted Arun oscillator. So yes, we would take our long right there. And if we look up here on the price action, that's a bounce off of the S1. So that's it. That's essentially how we would mechanically trade being as sprinters. So now let's look at what's currently happening with gold in real time. You notice that, wow, as I was doing this instruction, I should have taken that short in gold at 915, 918, 915, 918. That's a beautiful short. And how do we know it's a beautiful short? Because one, we created our ultimate signal one, we got blue MACD, zero cross down. Signal two, we have the ultimate peak. Signal three, the green dots, Arun and volume, are with us. Yes, take that down. And our first absolute exit is right there at 9:05, 10 seconds. And our second absolute exit is occurring right now at 9:27, and we'd be out of this sprint. And if we'd taken that, we would have been able to make our $230, our 23 ticks. So what could be more wonderful? So now I'm going to open it up to the people listening to this instruction for any questions that they may have. So Ray and Bruce, if you could please come in, and if you have any questions, ask it. This is now the question and answer portion. And I'm hoping that my description was clear enough.
I have no questions. I'm good.
Very good. Bruce?
No, I think you did a good job, Marty.
Wonderful. Okay, in that case, I will end the instruction and end this recording. And those of our other team members who are sprinters who are not with us today can review it to their heart's content at their own pace. So again, thank you for being with us, and many blessings as you employ this AIO-29 layout.
And